The biggest green candle you'll ever see is the last one. Not a warning candle, not a reversal signal. The biggest, most confident green candle on the chart, the one that makes you feel like you're finally right, that's the one that precedes the collapse. And in this video, I'm going to show you exactly how smart money engineers that moment. How they use your optimism, your confirmation bias, and your need to feel validated to exit their positions directly into your open hands. By the end of this, you'll understand how to read the footprints they leave behind. Not after the crash, before it. The volume patterns, the price behavior, the structural shifts that tell you the giants are quietly leaving the building while the retail crowd is still looking for the entrance. But here's what I want you to sit with for the next few minutes if the news is great. The market is at all-time highs, and everyone around you is confident. Why would that ever be the most dangerous moment to be long? Watch this video to the end, because the answer to that question will permanently change how you read a chart. Before we go any further, if you've ever held a position through a crash wondering what you missed, this channel exists for exactly that moment. Subscribe now. Because what comes next in this video is the kind of analysis that would have answered that question before it cost you. Most traders believe crashes are sudden, unexpected. Like a car accident, no warning, just impact. That's the story the media sells. And honestly, it's a comfortable story, because if crashes are random, then losing money isn't your fault. It's just bad luck. Wrong place, wrong time. But here's what Jesse Livermore understood 100 years ago that most traders still refuse to accept today. A major market collapse is never accidental. It is a slow, deliberate, methodical process of institutional distribution, and it takes weeks, sometimes months, before the floor finally gives way. The reason most people miss it isn't because they lack intelligence. It's because they're looking at the wrong things. They're watching CNBC. They're reading earnings reports. They're listening to analysts who have never placed a real trade in their lives. Stop, because everything you just assumed about how crashes begin is exactly what they want you to assume. Smart money doesn't announce itself. It doesn't send a press release. It moves in the structure of price and volume long before the headline ever gets written. And if you've been trading by reacting to news, you haven't been trading at all. You've been the exit liquidity. That's the first layer. The second one is where most traders get permanently destroyed. Let's talk about what distribution actually looks like, because it doesn't look like a top. That's the cruel part. During a real distribution phase, the market often still feels bullish. Prices are near highs. The news is positive. Social media is full of people posting their gains. And underneath all of that, the institutions are selling. They have to sell slowly. They're managing billions of dollars. You can't dump that kind of size without moving the market against yourself. So they sell into every rally. They let the price push up. Retail buys in with excitement. And they quietly offload another block of shares. Then the price dips slightly. Retail panic sells a little. Smart money absorbs some of it to stabilize the price. And then they do it again. This creates a very specific pattern on the chart. Wide, choppy, sideways price action near the highs. High volatility with no real directional progress. Candlesticks with long wicks. Rejections at the top. Rejections at the bottom. The market looks indecisive, but it isn't indecisive at all. It's being controlled. Now here's where volume becomes the most honest thing on your screen. There's a specific volume pattern that appeared 3 weeks before the 2020 crash, and I'll show you exactly what it looked like. During the final push to new highs in February 2020, volume was actually declining. Price was climbing, but fewer participants were driving it. Then, on the last few green days before the collapse, volume spiked violently. Massive green candles, huge volume, and retail traders saw strength. What they were actually seeing was institutional dumping. Smart money needed that retail buying frenzy to fill their sell orders. The biggest green candle was the last one. This is called Climax Volume, and it's one of the most reliable pre-crash signals in the history of markets, not because it's a perfect formula, but because human behavior around money is remarkably consistent. If that volume pattern just changed the way you read a chart, hit the like button. That one click tells the algorithm, this analysis is worth spreading. And right now, most traders out there still don't know what you just learned. We're almost at the core signal, but if I give it to you now, without one more layer of context, you'll misread it every time. So stay with me. Before a crash fully begins, there's almost always one final trap, a fake breakout above a key resistance level. The price pushes just high enough to trigger the stop losses of everyone who was short and to pull in breakout traders who've been waiting on the sidelines. Smart money needs those buy orders. They use that liquidity surge to complete their distribution, and then once their sell orders are filled, the support disappears and the price falls through the floor. Livermore went bankrupt 3 times. 3 times. And he still died the wealthiest speculator of his era. You know why? Because every bankruptcy taught him the same lesson from a slightly different angle until it finally became reflex. The market does not reward reaction. It rewards observation. 2 signals down. The third, the one almost nobody talks about, is coming up next. The mindset shift I want you to make isn't technical, it's perceptual. When you start understanding distribution phases, you stop asking, is the market going up or down? And you start asking, who is in control of this price right now? And what do they need from me? That reframe changes everything. Because once you realize you are a participant in a liquidity ecosystem, not just an independent analyst making rational decisions, you stop being surprised by manipulative price moves. You start expecting them. You start using them. The market doesn't move against you personally. It moves toward liquidity. And if you can identify where that liquidity is sitting, where the stop losses are clustered, where the breakout traders are waiting, you can stop being the target and start being the observer. I map out these distribution phases every single week before the move happens, not after. If you want to be in the room where that analysis lives, subscribe now, because by the time it shows up on your feed without a subscription, the setup is already gone. So what does this actually look like in practice without turning into a paranoid trader who sees manipulation in every candle? First, start watching volume on the weekly and daily timeframes during any extended uptrend. When price makes a new high but volume is lower than the previous push, that's your first flag. Not a sell signal, a flag. You begin paying closer attention. Second, if you start seeing wide range, high volume candles that don't result in sustained directional moves, price spikes up hard, then closes in the middle or lower. That's distribution behavior. Smart money pushed price up, sold into the move, and price couldn't hold. Third, look at how the market responds to genuinely good news. If a strong earnings report or a positive economic number barely moves the price or moves it up briefly and then fades, that's a significant warning. In a healthy trend, good news accelerates momentum. In distribution, good news is just another exit ramp for the institutions. None of this requires a Bloomberg terminal. It requires patience, a clean chart, and the discipline to do nothing until the evidence is overwhelming. That last part is what most traders never develop, because doing nothing feels like losing. But Livermore's most quoted principle was about exactly that. The big money is made in the sitting, not the trading. There's a psychological trap built into the crash itself, and it hits hardest right when you think you've finally figured it out. When the collapse begins, it moves faster than the rally did. And even traders who correctly identified the distribution phase often freeze or exit their short positions too early because the velocity of a falling market triggers a different kind of fear than a rising one. You were right about the direction, but you weren't prepared for the emotional experience of being right. That psychological trap I mentioned, here's what it actually looks like in real time. You're short. The market drops hard. You feel a rush of validation. Then it bounces sharply, and suddenly you're not sure. Was that the bottom? Was I wrong? And you close the trade right before the next leg down. The crash isn't the disaster. Your reaction to it is. What protects you in that moment isn't a better indicator. It's the work you did before understanding the structure, trusting your analysis, knowing why you're in the trade. If you entered based on volume divergence, distribution structure, and a failed breakout, those reasons don't disappear because the market bounced for 2 days. This is what it means to trade like Livermore. Not the bold calls, not the massive positions. The quiet confidence of someone who observed patiently, waited precisely, and then held their conviction when the chaos tried to shake them out. You don't need to catch every crash. You need to catch the ones you prepared for and protect your capital on the ones you didn't. That is longevity in this business. Progress beats perfection, observation beats reaction, and patience always beats impulse. But here's what I didn't tell you yet. There's one specific candle formation that appears inside every distribution phase, and it looks almost identical to a continuation signal. Most traders buy it. The ones who survive don't. That's the next video. Don't miss it. And one question before you go. I want a real answer, not a generic one. What was the moment you realized you weren't trading the market? You were feeding it? Drop it in the comments. I'm picking the most honest response and breaking it down in the next video publicly.